Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
I'm Terry Gallagher from the Fitch Ratings Investor Outreach Group. I'm joined by Josh Clark and John Kempf of the Fitch Ratings research team to offer their observations and provide insights on the current installment of the Fitch Bankruptcy, Enterprise Value, and Creditor Recoveries case study. The July report focuses on the gaming, leisure, lodging, and restaurant sector. Josh, before we discuss sector observations, what are some of the key takeaways from the report, and were there any findings that you'd like to highlight?
Thanks, Terry. One of the most notable findings from this report is just how rare gaming bankruptcies have become. Default activity for gaming operators has stayed light. The only real gaming or casino bankruptcy that we've seen in recent years is Maverick Gaming's filing last year. There has not been a major casino operator to file since Caesars bankruptcy back in 2015. This lack of default activity is reflected in our high-yield default rate and our leveraged loan default rate for the sector, both of which now sit at or below just 0.5%.
Okay, thanks, Josh. John, let's discuss the sector. Gaming, leisure, lodging, and restaurants has been pretty resilient. As evidence, the sector added only 3 new case studies to the bankruptcy data set. What can you tell us about the space?
Well, I think there's a few things here. First of all, the industry has matured, and that's pretty important. A couple things have happened here, or a few things have happened here. Number one, it's consolidated. There's been a lot of mergers and acquisitions throughout the past 10 years. So the companies are larger, they're more diversified, and they have more access to capital because of the scale and diversification that they bring. The second thing is maturity brings better understanding of operating efficiency. So there's more cost efficiency in the market. So that helps drive margins higher. And I think the third thing is when an industry is new, there's a lot of promotional spending. As it matures, the markets get a little bit more settled. That promotional spending comes down. So that's another added item that helps margins. A couple other things, expansion. Gaming is not expanding as much as it was before. There's 2 things to that. Number one, some of these expansions are very risky for the companies that are expanding. So you don't get a lot of capital structures that get too levered because of the expansions. The second thing is the companies that are in the markets that are seeing expansions from other gaming companies, they're not being affected anymore. So the competitive market is much more stable, and that helps. The third issue is alternative financing, mostly through sale and leasebacks that a lot of gaming companies have embraced through using 2 REITs, gaming and leisure properties and VICI properties. This has allowed them to sell their casinos to these REITs and then take that cash back that they've used either to pay down debt or to invest into their casinos. And that's a very effective and efficient form of capital for gaming companies, especially during downturns when the capital markets get a little bit tight. So the final point is gaming demographics, driven mostly by the baby boomers. Most gamblers are 50, 55 years and older. That's a growing demographic. These are gamblers that are gambling or spending mostly on their net worth, not on their income. And so that continues to be a strong customer now and going forward. And so that's resulting in pretty decent moderate growth despite some cyclicality that we're seeing. So that continues not just here, but we're also seeing that worldwide. So those are the 4 items that I think are kind of helping the gaming industry.
Okay, thanks, John. All right, Josh, we've covered default stats and sector specifics. What about creditor recoveries?
Sure. Well, on recoveries, first-lien lenders continue to do well. Of the 84 first-lien issuances that we've tracked across gaming, leisure, and restaurants, we've seen a median recovery of 88% and an average of 71%. In the rare instance a gaming company files, those recoveries have been especially strong, with the average closer to 90%. Restaurants, meanwhile, the recoveries in that area have been more mixed, with an average across those cases at just below 60%. And that variation reflects the weaker asset coverage and lease-heavy balance sheets typical of restaurants.
Josh and John, thanks again for sharing your perspectives. To access this report and more Fitch credit insights, please check out our research at fitchratings.com, and thank you for listening.
Subscribe to Fixed Interests wherever you get your podcasts.